When you think kind of 8 years into one of the biggest bull markets in the history of time is not the time to be adding risk.
Why would you want to buy a market when it's about as expensive as it has ever been in history?
Bear markets are the authors of bull markets, and bull markets are the authors of bear markets.
The thing that worries me more than anything else is what happens when these machines have to start selling.
This bubble is deeply systemic.
Volatility like we've never seen before.
We're going to have a recession when rates normalize. And if you think otherwise, you're delusional.
I think we're in the biggest bubble ever experienced.
It feels to me like we are very close to the end of that bubble.
We're going to have the worst bear market of your lifetime.
This is the greatest gift to sell stocks known to mankind.
That's the everything bubble. There's no place to hide this time.
We started Real Vision for a very important reason. Back in 2008, so many people came up to me and Grant and said, why didn't we know this was going to happen? Now, we were kind of at the center of the financial system. We knew, I'd been writing about it. Many of us had been talking about it. But many others didn't really know. They weren't aware. And we looked at this and realized the media had let people down and the banks had let people down. They just didn't want to tell people that bad things were out there and that they should pay attention. And when we started Real Vision, we swore that we would bring things to people's attention that they needed to know. Now, this is not just to sound bearish or alarmist. I'm not interested in that. The point being is that we're hearing things now from our guests that's coming up repeatedly and repeatedly in interviews. The drum beats are coming that something is about to happen. And I think it's really important that we come to you and explain to you what we're hearing. Again, we're not saying this is definitely going to happen. We're not saying we're just going to bring out a bunch of bearish people just because bearishness makes good viewing. It's really not for that. It's come from a purity of motive that if important people are telling us important things and we're hearing it from more and more and more of them and more frequently, we must pay attention. We must bring it to you to understand that there are risks building. That's really crucial for me and is the crucial reason that we started Real Vision. When we started interviewing people for this program, we realized there were a number of issues facing us. One was the record valuations in the stock market. Another was an issue with bonds and interest rates and debt included. Then there were issues coming out of the economy itself, the global markets, and also record low levels of complacency and volatility. Most of these things were suggesting that something big was likely to be happening. And again, I'm not talking imminently. It's not tomorrow the market's going to crash. What we're talking about is the levels of building of concern. And that usually means that in the coming 12 months, let's say, things are likely to change dramatically.
If you look at all of the different constituencies of the market today, it resembles the portfolio insurance debacle of '87 on steroids. So what it's going to take to set this off, we think is a 4 or 5% decline in equities immediately becomes a 10 or 15% decline. And so I think that's what you have to look for. When that happens, we're not exactly sure. But if it happens, if you see the equity markets crack 4 or 5 points, buckle up, because I think you're going to see a pretty interesting air pocket. And I don't think investors are ready for that.
Buying the stock market today is essentially taking an incredible amount of risk, at least as much risk as investors have ever taken in the stock market in the past, for the prospect of, I see it as zero reward, zero potential reward over the next 10 years. Is a very, very high probability that you make no money and maybe even lose money. I think there's a lot of parallels today to the early 2000 experience. And after 2000, stock market went down, 15% or something over the next 10 years. Gold went up 300-400%. And I think we're seeing we're in the midst of a very similar situation right now where there's all risk, no reward in stocks. And so if you're using the stock market as a part of a diversified portfolio, I can understand that. But people who are, overinvested in equities and or have home country bias or something like that, are going to learn a very painful lesson over the next few years.
We're going to have the worst bear market of your lifetime, of my lifetime even, next time around. Whether it starts this year or next, it'll probably start next year. If not this year, it will be the worst of your lifetime. Because in 2008, we had a pretty bad bear market because of too much debt. The debt is much, much, much higher now. In 2008, the Chinese had a lot of money saved for a rainy day, and they started spending it when it rained. Even the Chinese have a lot of debt now. So there's nobody left to save us.
We think that the answer to the question of the vol event coming onto the horizon is twofold. The first being geopolitically. It feels like geopolitically we're kind of coming to a boil with our relationship with North Korea and then with China. Things are worsening. Our trade relationship with China is worsening. Our relationship, whatever it may be, with North Korea continually worsens. And we've got 3 people at the heads of these 3 countries that are all there to try to make their countries great again. And I think that's a real risk geopolitically. But when we think about financially, which is actually easier to calculate, the financial reason is from the G4 central banks going from a period of accommodation to a period of tightening. And that's net of bond issuance. And so, we've talked about this before, but I think that it's important to think about accommodation going from $500 billion of accommodation in 2016 to $1 trillion worth of a draw in 2018 or more, depending on how the ECB tapers. That will have a profound effect on various asset markets. That will have a profound effect on vol when you have $1.5 trillion swing of capital coming out of markets in a 2-year period. So I think that in itself is worthy of spending a lot of time on as you think about asset allocation, as you think about vol as an asset class itself. Vol is not going to stay at realized levels of 8 or 9 in a $1.5 trillion reversal of accommodation.
We're at a very important junction. As we've talked about and I've written about, Babson warned everybody that we were nearing a peak in September of 29. And he had warned in September of 28 and in 27. So everybody dismissed him. And they said, oh, well, you were early, which means you were wrong. And he wasn't wrong. He was right. He was just, early. And the reality is at the point in time where we are today, so here we are in September of 2017. And yes, we said a year ago that things were looking bubbly. And whether we're at that final point or not, now is the time to start getting cautious.
We spoke to people like Kyle Bass of Heyman Capital, investment legend Jim Rogers, Mark Yuska of Morgan Creek, Julian Brigden, Jesse Felder, and a bunch of other people just to get some sense of what they thought might be happening in the stock markets. This is something I wrote about in a recent edition of Things That Make You Go Hum. And I just took a step back and looked at a chart of the S&P 500, which as you can see here is at levels we really just haven't seen before. And the 2 previous times we got even remotely close to these levels, everybody now looks back on and acknowledges that they were bubbles. But somehow this time seems to be different. And if you look at this chart from John Hussman, which shows the S&P median price to revenue, you can see clearly that we are at levels that we just haven't been anywhere close to in times gone by. So we wanted to get a sense from a bunch of really experienced investors as to what they thought when they looked at stock market valuations.
I think a lot about valuation in the terms of, we're at near all-time records for things like normal things like price to earnings, price to book. But the one that really gets me, and you talked about this in Things That Make You Go is that the median price to book is in a world of pure imagination, right out of Willy Wonka. It was bad enough in 2000, we were in Sillyville. Then we got to Stupid Town in 2007. And now we're just in this world of pure imagination because, what the median does is it gets rid of all of that accounting gimmickry the cap weighting does. So, I think about that a lot. And I also think that, unfortunately, it can go further than we all expect.
The way that I think about equity valuations, we think about them in kind of two ways. One is kind of enterprise value to GDP. And if you look at it on an EV or even just equity cap to GDP, we're back at the highest levels that we've ever been at in US history. Now, one would imagine that given a lower rate environment, that number should be higher, right? One could assume that the implicit yields on equities should be lower given rates close to zero. Therefore, historically, we should be able to accommodate a higher equity level. And I actually think that's right where we are. And so again, if I think we're going from a period of accommodation to a period of draw, then equity valuations are not going to expand. I think what we've seen is multiple expansion along with rates going to zero. And I think that's kind of going to come to an end. Now, does that mean that equities are never going to go higher? It doesn't. I mean, in the long run, I still think equities should grow with GDP. But I think this idea of 8 to 10% equity growth annually is an idea that won't last for the next 10 years.
Equity evaluations in America, there are a few stocks that have gone through the roof that people buy every day no matter what, but many equity valuations, especially if they're not in an ETF, are pretty cheap. Not cheap, but compared to the ones, the FANGs, for instance, there are many stocks that are not vastly overpriced in the US. Would I buy them? No, because when the FANGs pop, then everything is going to go down for a while.
More and more participants, in terms of the demand equation, have no negative consequences of overpaying for something. So the question of valuation almost becomes a secondary factor at this point. A Swiss National Bank, which now owns billions of dollars worth of US equities, for example, right, and Apple, is a central banker in Switzerland, will face no personal consequences if Apple goes down 30%, right? Or, issues of buybacks. I mean, these are, board-approved purchases, and they buy, and they have good reasons for why they do this. But equity investors find themselves increasingly in a sea of participants who have absolutely no personal consequences of getting it wrong.
This is the most pervasive overvaluation in the equity markets I think we've ever seen in history. By far, you look at the cheapest decile in the stock market, and it's the most expensive it's ever been. So it's not just the FANGs and things that people are looking at. It's every sector you look at, every segment of the market, and every size company that you look at. It's everything, and it's literally off the charts. I don't think we've ever seen anything like this.
The rally, for example, really concentrated in fewer and fewer stocks, mega cap stocks that basically drive the indices, right? So you see maybe corrections underneath already happening, rolling corrections, rotations from sector to sector to sector, but all the value is concentrated within a few stocks.
If you do want to talk about, ridiculous valuations, I looked back at the Nifty 50 and they had an average PE of, I think, mid 40s or something. When you average, the FANGs and you get a PE, well over 100. And so, a lot of these companies, look at the Russell 2000 and the PE is 75 or something for small caps. And, that's when you include companies that don't make money. And so people want to exclude that. But when you have a third of the companies in the Russell 2000 are losing money, that makes a difference. And so, I think Russell 2000 with a 75 PE is just, astronomical.
Our panel of experts weren't just concerned about stock market valuations. They were concerned about bond markets, interest rates, and central bank actions in general.
You've got this kind of realised now, very low return on equity on average, very low return on assets, very low sales growth. So what the bond market has been telling us all along is a reality. We're going to ever lower levels of nominal growth, ever lower levels of profitability, yet people are sticking equities on record levels of valuation. And the mismatch will come through disappointment in paying your liabilities, whether that's paying off that interest payment or paying a sensible dividend to your shareholders. That will feed through eventually.
In each cycle, the Fed tried to raise rates, right? As soon as there's problems, they cut rates to stimulate growth, to create the, bring everything back. But each time, the ability to raise rates has been stumped. Right? So we have lower highs and lower highs and lower highs in terms of the rate cycle, and now we ended up zero. At the same time, what's been happening is debt has been exponentially increasing, be it the US government, be it corporate debt, which is now 45% of GDP, be it consumer debt, right? So now you have this graph, which basically says, okay, well, we're gonna raise the effective funds rate. We want to, because that's what we've done over the last 30 years. So we keep telling everyone that we're gonna be able to do it. But each time they do it, oops, we can't. And right now, in this particular aspect of the cycle, we see the Fed again saying, we're done. They're not saying it outright, but we're saying, well, we're gonna stay at this level. Well, I know why you're staying at this level, because again, the growth curve is going down. If you look at loan growth, it's shrinking, right? If you look at any of the loan factors that are sinking. So there's already growth slowing in the economy.
Just printing money to allow people to borrow more works for as long as people have a certainty of what people are worth. As soon as that starts unwinding, then actually the central bankers lose control very quickly. Now the problem is, because I don't think they understand that mechanism, they'll come straight back in again to try and support asset prices. So they know declining asset prices cause a credit problem, but they don't realize that high asset prices are what credit people worry about the most.
Inflation is coming back in the Eurozone, and yet you have negative yielding bond prices in real price terms. It's going to be, when the market gets whiff of this, when ultimately starts to believe this, then I think the correction in the European fixed income market will be catastrophic. The amount of money that's going to be lost there is enormous, and it will have a huge impact over here.
Even though the economy overall looks relatively okay right now, many of our experts were concerned that things were not as good as seemed.
In America, we traditionally have had problems every 4 to 8 years since the beginning of the Republic. Doesn't mean we have to, but we always have. Maybe it's going to be 18 years now before we have problems. I doubt it. But this business cycle has not been wildly strong. This bull market in stocks, in some stocks, has been very, very strong. So the underlying reality of the stock market is based on artificial money printing. It's not real. It's artificial. And when it all pops, it's going to affect the economy, the real economy, and it's going to affect the financial markets. Remember, a lot of property in America has had a big, big rally since 2008. If interest rates go higher, interest rates are zero. Rising interest rates have always hurt property. So next time around, you're going to have property with problems again. You're going to have stocks with problems again. You're going to have bonds with problems again. Bonds, the last time we had an economic problem, were not a disaster because the interest rates, they were already still fairly high. So they could drive bonds higher and higher. You can't do it this time around. So you're going to have stocks, bonds, and property suffering next time around, which will probably mean some currencies will suffer around the world. No, it's not going to be fun.
The things that are similar are where exactly we are in the business cycle, and that's really quite astonishing. To me personally, I've never seen anything like that. So what I mean by that is US specific, because other countries are in a different position to respect to where they were 17 years ago in 2000. So for the US, for example, what we've observed is that the decrease in the unemployment rate and the length of that decrease in the unemployment rate is exactly the same. So in terms of where we are in the cycle, it's very similar, and not just in terms of unemployment rates. And we can also look at other employment indicators, employment cost indices. We can look at where we are in terms of the ISM. I know Raul likes to talk about that. So just in terms of the cycle, we are at a very similar point.
When I first spoke to Dorothy, I was absolutely blown away by her findings. She has 50 or so charts that show a very similar pattern to how things are now, going back to the late 90s, and it occurs all around the world. I featured some of these charts in the Global Macro Investor. Look at ISM, for example. It's an extraordinary fit. Now, don't expect these charts to be perfect, but their pattern is very, very similar. Even the S&P itself, it looks remarkably similar. It kind of suggests that the stock market should top out, maybe with another hurrah higher later in the year. Crazily, even stuff like consumer confidence is almost a perfect fit. These things are really extraordinary. I've never seen anything like this. And I guess it can all be summed up by this leading indicator chart. The comparisons again are spooky almost, and it's suggestive that something big is about to happen.
Generally, on average, the stock market tops out about a year before we fall into a recession. And I don't think that we see a recession this year. All indicators point towards a slowing down of growth. At best, we go back to trend. At worst, we fall below trend, obviously, and then into something that cleans out the system. And that would probably be the second half of next year. So we should look at that for timing, which means that the stock market should at least slow down here.
The other thing that repeatedly comes up from our guests is how low volatility is, and that's against an increasingly volatile world. Let's hear what our guests have to say about it.
We have European junk lower than 10-year treasuries. We have EM vol inside of NASDAQ vol. We have crazy people lobbing missiles in different places. We have a rising power threatening a ruling power. All of these things are happening all at the same time. I wake up each day and say, I don't even realize which world I'm living in anymore. And yet, equities march higher, vol continues to come lower, and the world is moving from active to passive like there isn't a bump in the road right in front of us. And I feel like there's a pretty material bump in the road. There could be a pothole that we might fall in in the near term, and yet we're speeding along at 100 miles an hour. And so there are these, there's a dissonance in the world today that I actually have a hard time putting my finger on.
Well, what we've been seeing is an unprecedented level of mean reversion. So every spike up becomes an will immediately result in mean reversion. And that has been at the highest levels of mean reversion truly in the history of realized volatility going back to the 1920s. A very unique phenomenon. And the intraday movement of markets, where you end up seeing this kind of pinning effect where the market comes right back to where it started. And this is the element of where if we're within these normal boundary movements, it's very, very easy for the share buybacks, for the vol targeting funds, for short volatility players to immediately cause a mean reversion in the market. But if we have some sort of external shock, all of these factors which compress volatility may actually serve to then become a volatility enhancer, to throw the system off.
The shift from active to passive means that risk is in the hands of people that don't know how to take risk, and therefore we're likely to have like a 1987 air pocket. This is like portfolio insurance on steroids, the way that algorithmic trading is now running the marketplace, where investors are moving from active managers to passive, meaning they're taking the wheel themselves, all at a time when CTAs are running their own algorithmic strategies where they're call it 1.5 times long and half short, and they all believe they can come out at the same time.
The next correction, the next recession, the next financial problem are going to be the worst in my lifetime, worst in your lifetime. America is the largest debtor nation in the history of the world. Many states, many pension funds are essentially underwater. So when you start having more problems, who's going to bail us out? Who's going to bail out the Illinois pension fund? Illinois cannot bail it out. People are leaving Illinois as fast as they can because they realize that they cannot pay the taxes.
Now, if we get a 10% correction in the S&P and the Fed immediately backs off, great, we all know what to do then. We just pile back in again and we push the endogenous risks further out. But I think those are still in the system, and when they bite, I'm looking for a much bigger correction, one that I won't immediately want to buy. And I'm looking in that scenario where bonds and equities both sell off together.
Inequality within the corporate sector. So you've got companies doing extremely well and lots of companies not doing so well. We know the story about wage growth. We know the story that these asset price rises haven't filtered through to the masses. So we've seen a lot of the political ramifications of that already, whether it's the US election or the French election or Brexit. You could argue the Eurozone is being held together at the moment, but what happens if the Eurozone goes into recession? What happens to the periphery there? So I think the real risk is in a recession that you get more extreme politics. People be wanting to take assets off people. Which is a danger. But again, in the UK, we had a lot of people suggesting that at the last election. So I think a recession at this point, where a lot of the population has not enjoyed the fruits of a recovery, I think is a very precarious place to be.
The very sad truth is income inequality is the highest it's been since 1929-30. There's a reason for that. We can go into that on another day, another time. But it's real. And the point you make about the average person doesn't have much savings. 40% of people in America couldn't come up with $500 for an emergency. I mean, that's a frightening thought. The average person around the world has no margin of safety. And I think that's why you see the risk of, civil unrest and potentially even warfare rises, because when people get desperate, they do really desperate things. And it doesn't take much to push us into a pretty significant downturn that would be exacerbated by demographics and debt and deflation to cause some real desperation. So I worry about that. When you have high valuations and you're late in a cycle, you probably should take less risks. So we think that you should be shifting to more defensive posture in a portfolio. And when you think about putting all of this together into a common theme or a common thread, you'd say this is a time to be more defensive as opposed to more aggressive. It's a time to look at the option value of things like cash and moving higher in the capital structure in fixed income and credit.
If you're an investor in this scenario, I think that given there are two sets of risks, there's the exogenous risks, the North Korean situation, the Trump tweet situation, or the bigger, more insidious, I think, endogenous risks, excessive growth and inflation, particularly in Europe. I think, look, it's difficult to time which one of those happens. But because they're both out there, and because markets are expensive, and because some of these bubble stocks in the US are exceedingly expensive and look like they're losing momentum, and because we've hit big levels in Europe, I just think these are times when you should just be taking some toys off the table. It doesn't mean, and I'm sure a lot of other speakers will say this same thing, that you go out and then you rush and you just buy a ton of puts, okay? But you can look at things like emerging markets, which have an amazingly good run, and begin to tighten up some risk in this thing.
The only thing you can do to survive something bad is to stay with what you yourself know. You start listening to hot tips, you're going to lose a lot of money. So stay with what you know. If you don't know anything, put your money in the bank and wait. Wait until you find something that everybody watching this knows a lot about something, whether it's sports or cars or fashion. Everybody knows a lot about something. Find opportunities in the area that you know a lot about. If you know about fashion, you're going to see changes long before I do. I know nothing about fashion and don't care. You will see good things happening or bad things happening long before I will. And that's what you should be doing with your money. Stay with what you know.
I do think this is a time where you want to be cautious. You want to increase the flexibility in your portfolio, which means hold more cash, and not be so concerned about missing out. You know, the FOMO, fear of missing out, is governing everybody's actions today, and they're buying things with really, we think, no chance of having a good positive return over the next 7 to 10 years, simply because the price is rising. And when you buy things simply because the price is rising, you're basically saying that the price discovery mechanism is broken and it's all about momentum. And that's just a bad investment strategy overall.
As you can see, there's a number of really smart people who think something big is about to happen. And I think that's the important message I wanted to give you. Not that there's a crash tomorrow. It's not about market timing here. It's about telling you that the drum beats have got so loud that it's time to really point it out to you. So what does this all mean for you? Really, you should think about maybe buying protection or maybe reducing some of the risks that you have. At least have a plan. Because if these things happen, they happen very quickly. And again, I think the market may even have a blow off top. I'm not particularly looking for something bad to happen immediately. It could well do, but it's not my base case. But that means that still, I'll be planning reducing risks, thinking about where I should put my money, drawing in some cash, and just being a little more cautious. To miss the final stages of a bull market always feel a little bit scary. But you know, it's often the right thing to do. You'll always grapple in your head, but what happens if it goes on for another 2 years? And I'll look back and I didn't make that money. But let's say the market goes up 10%, 15% from here. Let's say as a blow off top goes up 20%. But the downside may be 50, 60, 70%. You know, the size of these imbalances are really big. So the outcome is probably quite nasty. So I think from a risk-reward perspective, just being a little more cautious and understanding that this is not the time to step up to the plate and take huge risks, I think is the key message. Something big is about to happen. Not imminently, but it's coming. So we pulled together an incredible group of people to talk about what the big event on the horizon is, the edge of the cliff.